I have made a fortune dancing on the graves of investors who believe that this time was different. It isn't, and the market is about to give them a very expensive lesson. Look around you. It's 2026, and the smell of rot in the office sector is finally becoming impossible to ignore, even for the most delusional optimists on Wall Street. For 5 years, I've watched people play a game of extend and pretend, hoping that if they just waited long enough, the world would go back to 2019. They thought that a few fancy espresso machines and some collaborative workspaces would magically lure people back into 40-story monoliths. That they were wrong, they were arrogant, and now they're broke. They just haven't realized it yet because the paperwork hasn't cleared. The cost of that arrogance is what we're seeing today. You have trillions of dollars in commercial real estate debt hitting a brick wall, and there's no ladder long enough to climb over it. Everyone in this business loves to talk about complexity. They love their proprietary algorithms, their 10-year projections, and their alternative data sets. It's all nonsense. It's a smokescreen designed to hide the fact that they've forgotten the most basic fundamental law of the universe, the law of supply and demand. If you have more space than you have people willing to pay to sit in it, the value of that space is heading toward zero. It doesn't matter what your spreadsheet says about pro forma rent growth or exit cap rates. If the cash flow isn't there to cover the debt, you don't own an asset. You own a liability that happens to have a nice view of the skyline. I've spent my entire career looking for the gap between perception and reality. Right now, that gap is wider than the Grand Canyon. Wall Street perceives a temporary adjustment. Reality is a fundamental structural collapse of the office-centric economy. I'm a grave dancer. That's the nickname the press gave me decades ago, and I wear it with pride. It doesn't mean I'm morbid, it means I'm a realist. When the music stops and the lights go out, I'm the guy who's still in the room with a flashlight and a checkbook. And right now, the lights are flickering in every major business district from New York to San Francisco. We are entering the greatest period of wealth transfer in the history of real estate, and it's happening because people forgot the basics. They forgot about replacement cost, they forgot about barriers to entry, and most importantly, they forgot that in a crisis, liquidity isn't just a convenience, it's survival. I'm going to tell you exactly how this bomb is going to detonate, and before we're done, I'll reveal exactly where I'm seeing the most profitable corpses in this market, the places where the smart money is running away, and where I'm getting ready to step in. But first, you have to understand why the current system is a house of cards. For a decade, we lived in a world of 0% interest rates. That environment didn't just encourage investment, it encouraged stupidity. It allowed developers to build commodity office towers that had no business existing. They weren't building for tenants, they were building for the exit. They were building because the cost of capital was lower than the yield, no matter how skinny that yield was. They ignored the fact that office buildings are capital-intensive beasts. They require constant TI, tenant improvements, and commissions just to keep the lights on. When your interest rate is 0, you can hide those costs. When your interest rate is 5 or 6%, those costs eat you alive. The growth analysts, those guys in the expensive suits who have never actually signed the front of a check, will tell you that flight to quality is going to save the market. They say that as long as you have a Class A building with a gym and a roof deck, you'll be fine. That is absolute garbage. A flight to quality in a dying market is just choosing which deck chair you want to sit in on the Titanic. If the total demand for office space has shrunk by 30%, it doesn't matter how nice your lobby is, you're fighting over a shrinking pie, and the only way to win is to cut your rents. And once you cut your rents, your valuation disappears. I've always focused on capital preservation. If you protect the downside, the upside takes care of itself. But the people holding these empty skyscrapers today did the opposite. They chased the upside and ignored the asymmetric risk staring them in the face. They ignored the fact that the work from home trend wasn't a temporary pandemic blip, but a permanent shift in the utility of the asset. If a building is only used 3 days a week, it's not worth 100% of its previous value. It's worth significantly less. Yet the debt on these buildings is still based on 100% occupancy at peak rents. That is the trillion-dollar bomb. Let's talk about replacement cost. In a normal market, the value of a building is somewhat tethered to what it would cost to build it today. If value falls below replacement cost, people stop building, supply dries up, and eventually prices recover. But that only works if there is demand. If I give you a brand new buggy whip factory for free, you still can't make money because nobody wants buggy whips. We are reaching a point in many major cities where the value of an office building is less than the cost of the land it sits on. That is a level of distressed assets we haven't seen since the early 90s. I'm looking at these zombie skyscrapers, buildings that are 60% leased but only 20% occupied. The tenants are still paying rent for now, but their leases are burning off. Every month that goes by, we get closer to the cliff. And when that cliff arrives, the owners won't have the cash to release the space. They won't have the money for the tenant improvements. The bank will look at the building, look at the vacancy, and realize that the collateral is gone. That's when the grave dancer starts the music. What fascinates me is the sheer scale of the denial. You see these major REITs and private equity shops reporting stable valuations. How? They're using internal appraisals based on comparable sales from 3 years ago. There are no comparable sales today because no one is buying. The market is frozen. And when a market is frozen, the price is whatever the last guy was desperate enough to pay. The illiquidity premium has turned into an illiquidity penalty. If you have to sell today, you're taking a 40 or 50% haircut. If you don't have to sell, you're just pretending you're still rich. I've always said that I'm a net buyer of panic, but to buy panic, you have to have the stomach to look at a disaster and see the bone structure. Most of these office buildings are obsolete. They're commodity space. They have no barriers to entry. You can't fix a building that shouldn't have been built in the first place. The only way to win in that scenario is to buy the debt at such a massive discount that your basis is low enough to survive anything. If I buy a loan for 20 cents on the dollar, I don't care if the building stays half empty. My margin of safety is so large that I can wait out the decade. But most of the guys in the market right now don't have that luxury. They're leveraged to the hilt. They have CMBS maturities coming due that require them to refinance at double the interest rate with half the appraisal value. It's a mathematical impossibility. The banks don't want the keys, but they're going to get them anyway. And the banks aren't operators. They don't know how to manage a skyscraper. They're going to want to dump those assets as fast as possible to clean up their balance sheets. That is the opportunity. That is where the corpses are going to be buried. I hear the growth guys talking about repositioning and office to residential conversions. They make it sound so simple. Just move some walls, add some plumbing, and presto, you've solved the housing crisis. It's a total fantasy. The floor plates in these buildings are too deep. The elevators are in the wrong place. The windows don't open. By the time you're done gutting the place and bringing it up to code, your cost per square foot is higher than if you had just built a new apartment building from scratch. It's a classic sunk cost fallacy. People are throwing good money after bad because they can't admit that their original investment is a zero. In my world, you have to be able to look in the mirror and say, I was wrong and this asset is dead. Only then can you move on to the next deal. But the ego in this business is massive. People would rather go bankrupt than admit they bought a dog. They'll keep pouring capital into amenities and lobby upgrades, hoping that a new coffee shop will suddenly make a 30-year-old building in a secondary market relevant again. It won't. The world has moved on. The utility of the office has been disrupted by technology, and the supply is now permanently disconnected from the demand. We are seeing a total repricing of risk. For years, institutional real estate was considered safe. It was where you put pension fund money to get a steady 5% return. Those days are over. Office real estate is now a high-risk speculative asset class. It's distressed by definition. And when the risk profile of an asset class changes that dramatically, the cap rates have to explode. If you were buying at a 4 cap and now the market demands a 9 cap, your building just lost half its value. It's simple math, but it's a math that wipes out trillions of dollars in equity. I'm watching the regional banks very closely. They are the ones who are most exposed to this commodity office debt. They don't have the too big to fail cushion of the giant money center banks. When these loans start defaulting, and they are starting, the capital ratios of these banks are going to get shredded. They'll stop lending to everyone else to protect themselves, which will trigger a credit crunch. That credit crunch will be the catalyst for the next leg down in the economy. It's a domino effect, and the first domino was the belief that everyone has to work in an office. I've spent 50 years watching cycles. I saw the REIT revolution in the 90s, the crash of 2008, and the long recovery. The one thing I've learned is that the market is a very efficient machine for transferring wealth from the impatient to the patient. Right now, the impatient are the ones trying to save their dying assets. The patient are the ones sitting on a pile of cash waiting for the forced liquidations. I've always been happy to wait. I don't need to be the first guy into a deal. I want to be the guy who buys from the guy who was the first guy into the deal. The work from home crowd thinks they've won. They think they've liberated the workforce. What they've actually done is destroyed the value of the urban core. And when the urban core dies, the tax base disappears. When the tax base disappears, the services decline, crime goes up, and the downward spiral accelerates. You can't have a 40-story skyscraper in a city that can't afford to pick up the trash. The value of real estate is inextricably linked to the health of the environment around it. That's why I've always been a top-down investor. I look at the macro first, and the macro for major urban office centers is as ugly as I've ever seen it. But don't get it twisted. I'm not a pessimist. I'm an opportunist. A bloodbath is just a sale with a more dramatic name. The trick is knowing what's a bargain and what's a trap. A bargain has a future utility. A trap is just a monument to a past that isn't coming back. I'm looking for the assets that are mission critical. I'm looking for the locations that have such high barriers to entry that they will eventually recover, even if it takes a decade. But I'm only buying them at a price that reflects the current reality, not some pro forma dream. The growth analysts will tell you I'm too old school. They'll say I don't understand the new economy. I've heard it all before. I heard it in 1999 during the dot-com bubble. I heard it in 2006 before the subprime collapse. Every time people start talking about a new paradigm that ignores the basics of cash flow and supply and demand, I reach for my wallet and start checking the exits. I'd rather be a year too early than a minute too late. And in 2026, the people who are still holding on are already years too late. The bomb is already ticking. You can hear it in the silence of the half-empty lobbies. You can see it in the for lease signs that have been up for 3 years. You can feel it in the desperation of the developers who are suddenly willing to partner with anyone who has a little bit of liquidity. They don't want a partner, they want a lifeline, and I don't throw lifelines. I buy the boat after it's already sunk. That's the thing about this business. Everyone wants the glory of the top, but nobody wants to do the dirty work of the bottom. But the bottom is where the real money is made, and the bottom of the office market is currently a dark, crowded place where the smart money is currently suffocating. You have to understand that we are witnessing a fundamental repricing of what it means to own a city. For decades, the skyscraper was the ultimate trophy. It was the blue chip of any portfolio. But a trophy that doesn't produce cash flow is just a very expensive paperweight. And right now, these paperweights are being carried by banks that have no idea how to value them. The illiquidity premium that investors were promised in private equity funds has turned into a prison sentence. For years, fund managers told their limited partners that by locking up their money, they'd get a higher return because they were avoiding the volatility of the public markets. Well, the volatility caught up to them anyway, and now they're stuck. They can't sell their assets because there's no market, and they can't return the capital because there's no liquidity. That is a recipe for a disaster that is going to play out over the next 3 to 5 years. It's not a flash crash. It's a slow motion train wreck that is going to dismantle some of the biggest names in the industry. I told you I'd reveal where I'm seeing the most profitable corpses, and it's not where the crowd is looking. Everyone is obsessed with the flight to quality in Manhattan or Chicago. They think that because it's a famous building, it has to be worth something. I disagree. I'm looking at the distressed assets in the secondary markets, places like Charlotte, Nashville, or even the suburbs of Dallas. These are places where the barriers to entry were never that high to begin with, and where the oversupply is so massive that the current owners are literally handing the keys to the lenders just to walk away from the headache. I'm looking at the debt, not the equity. Why would I buy the building when I can buy the loan at 40 cents on the dollar? If I buy the loan, I control the outcome. If the borrower miraculously pays me back, I've made a massive return on my capital. If they default, which they will, I end up owning the underlying asset at a basis that is so low, I can afford to let it sit empty while I figure out what to do with it. That's the margin of safety in its purest form. I'm also looking at the land. Sometimes the building is so obsolete that its only value is the dirt it sits on. In cities where there's a massive shortage of housing, which is almost every major city in this country, the corpse of an office building is actually a phoenix waiting to happen. But you have to buy it at replacement cost or below. If I can buy a building for less than the cost of the land and the steel, I've protected my downside. I can tear the thing down and build residential or industrial or whatever the hell the market actually wants. The people who are going to get slaughtered are the ones who try to bridge the gap with more debt. They think they can reposition an asset with a high interest loan. That's like trying to put out a fire with gasoline. Let's talk about cash flow again, because it seems to be a foreign concept to this new generation of investors. They talk about multiples and growth trajectories. I talk about dollars in the pocket. If a building doesn't generate cash flow today, it's a speculation, not an investment. And in a high interest rate environment, the cost of carrying a non-productive asset is ruinous. I've built my entire career on the idea that I want to be the guy who owns the plumbing. I want the assets that people need, not the ones they want when they're feeling flush. And right now, nobody needs a sea of cubicles in a mid-block building in a dying downtown. They need fulfillment centers, they need data centers, and they need places to live. The asymmetric risk right now is weighted heavily toward those who think they can outsmart the cycle. You can't outsmart a cycle, you can only survive it. I've seen so many brilliant guys go broke because they didn't have the discipline to wait. They felt like they had to do something. I don't feel like I have to do anything. My job is to protect my capital until the opportunity is so obvious and so lopsided in my favor that it would be negligent not to act. That's what being a grave dancer is all about. It's not about luck. It's about having the liquidity and the guts to step up when everyone else is paralyzed by fear. The analysts are going to keep telling you that the bottom is in. They've been saying that every 6 months for the last 3 years. They say it because their job depends on people buying things. My job depends on being right. And I'm telling you, the real pain hasn't even started. We are just now seeing the first wave of defaults. The second wave is going to be the banks realizing that the collateral they're holding is worth half of what they thought. The third wave is going to be the forced liquidations. That's when the bloodbath gets interesting. That's when the prices move from distressed to ridiculous. And that's when I'll be doing my best work. The reality of 2026 is that the work from home delusion has permanently damaged the urban ecosystem. When you lose the office worker, you lose the lunch trade. When you lose the lunch trade, you lose the restaurants. When you lose the restaurants, you lose the street life. And when you lose the street life, the city becomes a place where nobody wants to be. It's a downward spiral that is very hard to stop once it starts. But even in that spiral, there are pockets of resilience. There are mission-critical assets that will always have value. The trick is knowing how to tell the difference between a bargain and a trap. Most people are looking at the wrong numbers. They're looking at unemployment rates or GDP growth. I'm looking at the shadow vacancy. I'm looking at how many people are actually swiping their badges at the front door compared to how much space is officially leased. The gap between those two numbers is the real story of the office market. If a building is 90% leased but only 20% occupied, that 70% gap is a ticking time bomb. When those leases come up for renewal, those tenants aren't going to take 100% of their space back. They're going to take 30%, or they're going to leave entirely. That's the bloodbath that's baked into the cake for the next several years. I've always been a big believer in being the low-cost provider in any business. If you can provide the same service at a lower cost than your competitor, you win. In real estate, that means having a lower basis. If I buy a building for $100 a foot and my competitor across the street bought his for $400 a foot, I can underprice him all day long. I can offer better concessions, lower rents, and still make a healthy return on my capital. He, on the other hand, is working for the bank. He's just a glorified property manager for his lender. Eventually, the lender's going to figure that out and take the keys. That's when I'll be waiting at the front door. The sheer volume of debt that needs to be refinanced in the next 18 months is staggering. We're talking about a wall of maturities that is going to hit the banking system like a freight train, and the banks are already skittish. They don't want more office exposure. They're being told by regulators to clean up their balance sheets. So when a developer comes in with a building that's worth 30% less than it was 3 years ago and asks to roll the loan, the bank is going to say no, or they're going to say, sure, but you need to write us a check for $50 million to bring the loan to value back into line. Most of these guys don't have $50 million. They have paper wealth tied up in other failing projects. That is the essence of capital preservation. It's not about how much you make when things are good. It's about how much you keep when things go bad. I've always made sure that I was never the guy who was stuck. I want to be the guy with the keys when the gate finally breaks. The asymmetric risk right now is weighted heavily toward those who think they can outsmart the cycle. You can't outsmart a cycle. You can only survive it. We are seeing the end of the cheap money era, and the hangover is going to be brutal. For a decade, interest rates were so low that even a monkey could make money in real estate. You just bought something, waited 3 years, and sold it to a bigger fool for more money. That era created a generation of developers who wouldn't know a fundamental if it bit them in the ass. They are spreadsheet monkeys who think that if you change a cell in Excel from 5% to 4%, you've magically created value. Well, the real world doesn't work in cells. The real world works in cash flow, and if the cash flow isn't there to pay the mortgage, the bank doesn't care about your internal rate of return projections. So where should you position your capital? You should position it where the panic is the greatest, provided the underlying asset has a future. I'm looking at the debt pieces of commodity office buildings in secondary markets. I'm looking at the land under failing skyscrapers in high-growth cities. And I'm looking for the institutions that are being forced to sell at any price to meet redemptions. When an insurance company or a pension fund decides they have to get out of office, they don't care about the last nickel. They just want the asset off their books. That's my favorite kind of seller. My advice to you is simple. Ignore the noise. Stop listening to the people who tell you that recovery is just around the corner. It isn't. We are in a structural shift, and the world is never going back to 2019. The work-from-home delusion is going to crash the economy because it's a symptom of a much larger problem, the misallocation of capital on a massive scale. We've built too much of the wrong stuff, and now we have to pay the price. But for the people with the discipline to wait and the liquidity to act, this is the opportunity of a lifetime. Focus on the numbers, protect your downside, and for God's sake, stop believing that this time is different. It never is. The names change, the buildings change, but the math stays the same. The 2026 office bloodbath is here, and the only question is whether you're going to be the one on the ground or the one doing the dancing. I've spent my life watching cycles, and I can tell you that the most successful people are the ones who can look at a disaster and see a clearing. They are the ones who understand that wealth isn't created during the boom, it's created during the bust. The boom is just when you collect the chips. The bust is when you buy the table. So get your house in order, preserve your capital, and be ready. Now, if you found this useful, do yourself a favor and subscribe to the channel and hit that like button. It's the only way you're going to stay ahead of the curve while everyone else is busy losing their shirts. And look, if you think I'm wrong, if you think the office market is a screaming buy right now, or that I'm just a grumpy old man who doesn't get the new economy, then by all means, leave a comment below. My team and I will be looking through them. Tell me your thesis. Show me your numbers. But let's be clear. I'm interested in arguments based on real-world fundamentals, not your hopes and dreams. If you've got a real case to make, I'm all ears. If you're just high on hopium, don't waste my time. I've got graves to dance on. Would you like me to look into another sector where the fundamentals are being ignored?